Hey, what's up, bud? How are you? Now you fill out right here, get your signature on here, fill this out so you get your grade. All right, there he is. That's the one that I want to
Hey guys, we're going to go ahead and get started. Just keep things rolling. Grab food, drink, whatever you want as we're going through this. Before I introduce Susan here real quick, I'm going to let Matt come up here. Matt, if you guys want to talk a little bit about that neighborhood just for a quick second. Sure. And just make sure everybody knows where they are and where.
All right. So most of y'all, familiar faces, been out here several times. We've got about 29 inventory homes left.
Sounds right.
And they can close by the end of the year. We've got some pretty good incentives going right now, price incentives. Some of our homes we have $7,000 off. Some of them we have $10,000 off.
Okay.
You know.
Bottom line is, bring Ryan around here. We'll let you win a negotiation.
Yeah. You wanna win a negotiation? We'll do it for you. We'll help you out.
We're going to lay down.
And we don't do that much.
We don't. We don't really give anything out here typically. But so then we have a few lots left that you can build. Probably about 9 lots left with the 4 construction trailer lots over there in the last section or last phase, and then we'll release 24 lots around the model, and then we'll be done. So probably next March, April, May. Hopefully by May we'll be closed out. It's our goal. So.
Yeah. Probably last best chance to get buyers into something at this price point. I don't think we're going to have anything like this when we follow onto this community. I don't have anything remotely like this price point. So
that's pretty much it. So yeah, thanks a lot.
Yeah, thank you guys for letting us have the class out here. I know everybody wants to get their 2 hours in. Thank you guys. Real quick, my name is Cody Reid. I'm with NRL Mortgage. So thank you guys for coming out. I'm gonna kind of play backup, I guess. I'll let you run the class. Occasionally, I'll kind of step in and out. Anything that might apply to mortgage as far as anything credit goes. But just 2 seconds about me. We are one of the preferred lenders here at Milestone. So if you guys are working with Dennis or Matt here, just grab one of my cards on the way out. Anytime you pop in, just say, hey, I just love that Cody guy, man. He's on it. Just ask to use me, and we'll do a great job and take care of you and your buyers. So, and with that, I'll turn it over to Susan.
Do you have a lending product for people with an I-10?
An I-10, technically we have a portfolio loan for an I-10 product. Usually that means they have to have money in the bank.
Yes, they've got it.
Okay,
But what kind of interest rate are you looking at?
6, 7, 8, 9, I have no idea. It's pretty rare when we do the I-10. I'm talking like once a year type of, we'll close 500 loans, so we can do 1 I-10. You know what I mean?
You can give me a good interest rate. You can do 2 this year.
We can do all kinds of portfolio products. Like I'm talking bank statement loans, liar loans, stated income loans, like whatever you want to call them. Like we've got a lot of those weird products. The interest rates stink. And you try not to push them on a lot of people. So if somebody actually has income and a regular job and stuff like that, things that we can verify, they'll get a normal loan with a rate in the 4s or the 5s or something like that, depending on what their credit score is. So yeah, those alternative loan products, I don't advertise them very often. Like we can do them all. I don't advertise them because the rate's 6, 7, 8. I've seen a size 9% on some of those as well. Yeah.
Well, they're higher risk.
Yeah, they're higher risk. So. But if
that's the only way they can.
if that's the only way they can get a loan and they're okay with that, we're totally fine putting a loan together like that. So usually it takes something going for them, either money in the bank or income or something to kind of make the deal work. So yeah, guys, and so we can do everything: USDA, FHA, VA, TextFed, Jumbo, conventional.
Where are you housed?
What's that?
Where are you housed? Right here.
I'm at Far West and Mopac.
Okay.
So kind of right in the middle
Every
of
lender
Austin.
I know is in that area, Spicewood area. Right.
Yeah. It's nice. I got people in the north, I got people in the south, so everybody kind of in the middle. So, anyways, guys, I'm gonna be hanging around all afternoon. So if you guys have any questions on anything lending, just please do shout it out. Ask questions as we're going through this too. So with that, just by the way, Elevate My Scores. We work with them a lot. Susan and I've known Chris for years, and Chris connected me with Susan, and just their whole team is just a great operation as far as working. James, I think we closed 1 or 2 people with. We're still actively working on pipeline people. So, anyways, they're just good at what they do as far as following up with people, and people have worked, I'm sure everybody in here has known or worked or talked to some kind of credit repair company before. I would say they're on the more affordable side and actually productive side, in that they actually get results and they don't cost an arm and a leg. Because I've seen some that cost too much money and nothing ever happens. You pay a bunch of money and nothing ever happens. So we've actually closed transactions, gotten results, done the work for 3 months, 6 months, however long it's been, their person's different, and closed the transaction. So that's why I come back to them, I ask them to come in and please help me in class. It's a 2-hour CE for you guys, but again, it's just it's a beneficial service. They actually do provide results. So that's why I use them. So with that endorsement, Susan, I'll let you.
That's an awesome comment there. Appreciate that. Because when I know those word of mouth referrals really mean a lot in this industry. My name is Susan Isenhour. I am the regional director for Elevate My Scores in the Austin area. The owner of the company, Chris Bush, is my brother, and so I am stepping on board in the company with him to help him grow the marketing outreach in the Austin area. So you'll see me around doing some classes like this to help get this information into your hands, because we really feel like you are on the front lines with clients, building relationships, and we want you to have that information. It's just credit can be so confusing, and like Cody said, there are unfortunately we hear a lot from clients that have been with other credit repair companies and have paid lots of money and haven't gotten anywhere. And we hear that story way too often. Our business model is that we are going to go after as many things as we can in a short period of time and control the costs, and then let your client out when they're ready. Not hold them into any kind of a long contract. But we'll go into some of the specifics of our side of the business. But I want to share with you some really great information about credit today. This is a 2-hour CE class, and so you'll get 2 hours of credit. Just make sure that you've signed in on that sheet that I've got your number and email address, so we can give you the credit. This class will also be offered in the next season of classes at ABOR. So we're really excited to be able to have some outreach there, and that will be. So when I say you'll be seeing me around, you might be seeing me there as well. So if you know of someone who might benefit from this class and you want to share the word with other realtors, you can certainly look me up and see when we'll have another class in the area. But coming up in the next course catalog with ABOR, we'll be there. So. All right, and then make sure you have a packet too, so that you can take some notes. You're gonna hear some things, and there's some more packets back there. But you're going to hear some things and have some questions, and so it's always good to take some notes. If you have specific questions about a client or about something that you're working on right now, maybe kind of table that, and I'll stick around for a little while afterwards. Cody will be here too, so if you've got a specific issue that you want some help with, we can certainly talk about it at the end. But feel free to chime in and ask questions that kind of general questions as we go along. As I said, we're really passionate about educating about credit because it is so confusing, and the industry, how it works in the mortgage industry as compared to the internet and in insurance and in the auto industry. So part of what we're doing today is just trying to get this information out there. So why do you think you see 3 different scores on a credit report? Different information, okay. So the 3 credit bureaus are Experian, Equifax, and TransUnion, right? So when you see a mortgage credit report, you're going to see a score from each of those credit bureaus, right? Okay, but shouldn't they be the same, right? You would think they would be the same, right? But they're not. And so has anybody ever wondered why they're different? Yes. So what happens is that different creditors report to different credit bureaus, okay? So you might have one, one collector or one trade line that reports to Experian, and then you have another one that will report to all three, right? So that's one way that you can see those differences in the scores, right? But also the different creditors will report different information on different days of the month. So for example, you might have like Capital One, not picking on them, but a lot of people have a Capital One credit card, right? So you might have Capital One that would report to one bureau on the 1st, but then it might report to the other bureaus on the 15th, right? And you know what your revolving account looks like. That balance changes during the month depending on when you make your payment and what you're charging in between those times, right? So that's another reason why information can be different across those three bureaus, right? Okay, so like on the 1st, you could report like a $400 balance on your credit card, and on the 15th it could report a $50 balance. Yeah, right. So, and that's why those trade lines, might be an issue there. So you guys are familiar when I say the word trade line, what I mean there? So an account that reports across the three different credit bureaus. So a trade line would be a student loan, right? That would report on all three credit bureaus, right? That one account is called a trade line. It's just an industry term that we use to help us keep track of those information. So one credit card account, one collection account is a trade line. So
do you guys check all three when you're checking someone's credit, or do you just pick one, work with one credit?
So
On the mortgage side,
On the
so
mortgage
in
side.
real estate, yes, we'll check, mortgage companies will check all three.
yes, they will. Because of that reason, because different things report to different, so they're looking at the combination of all that information out there, right? Okay. So there are over 100 different ways to compute a credit score. So 100 different ways to get the same answer about you. So no wonder it's confusing for your clients that see their credit score on their Discover bill, right? And that says they're a 625. You're shaking your head because that sounds like maybe that's happened to you, right? So so they get their Discover bill and they say they're a 625 and they say, all right, great, I should qualify for that, right? But that methodology that was used to get that score is not the same that Cody is going to use when he's pulling up a mortgage credit report, right? And in fact, that mortgage credit score on average is going to be about 40 to 50 points lower than what you're going to see on your Discover bill or on Credit Karma, right? Yes. Okay. So you guys have all heard of FICO?
Yes.
FICO. Anybody know what FICO stands for?
Federal something.
It's not federal, actually. No, it's not. It's not. Fair Isaac Corporation. So, yes. Not what you thought it would be at all, right? Right. Okay. So, the Fair Isaac Corporation was founded in the late 60s, and they invented credit scoring. Okay. And today, FICO is the law of the land when it comes to credit scoring. 90% of lending decisions are drafted using some sort of FICO methodology, right? Okay. But even within FICO, there are 49 different formulas used in FICO, right? So, right? No wonder this is so confusing, right? So I'm just giving you all this information. Not to frustrate you, but just to understand that that's why there is no absolute answer when it comes to all of this, right? Okay. So, and then in the mortgage industry, there are 9 different of these formulas that are used in mortgage. And we're going to use the word algorithm a lot today. Algorithm is just like the algebra problem, right? That is used to compute the score, right? So the different areas of importance, and then the percentages that are used to weight all of that out. And we're actually going to break down the whole mortgage FICO algorithm here in just a little bit to show you a little bit of that, okay? There are, like I said earlier, there are 4 different industries where credit scores are used. There's the mortgage industry, of course. There's the auto industry. In insurance, credit scoring is important. You guys weren't aware of that. And then credit cards, and then also out there on the internet. So how many of you guys use Credit Karma to look at your credit score? Anybody? A couple, 2, 3 people? See some head nods. So Credit Karma is a great just beginning for looking at your credit, because you can track it going up and down. But they use a scoring model called Vantage. Okay. Vantage is not FICO, right? And it is generally about, like I said, 40 to 50 points higher than a mortgage credit report, okay? So the important thing here is that when your client comes in with their Credit Karma at 625 and says, let's go shopping, right? What should your answer be?
We need to find a loan officer.
We need to go find a loan officer. We need to go call Cody, right? Okay. All right. And let him pull the credit, right? But then when Cody pulls the credit and it's a 580 and not a 625, you've got to be there with them to help them understand that they're not going to get a different answer if they go to SWBC, right? Or if they go to Infinity Mortgage. They're not going to get a different answer. It's going to be the same answer, okay? That's the mortgage credit score, and that's just the way it is. So it's not Cody's fault that it's different than Credit Karma, that it's the way that credit scoring is done, and that the different algorithms that are
The
used.
problem is that people really think that those are their scores. They don't understand, you know?
You're right. You're right. And that's partly what you get to help them, you know, navigate through all of this, right? And that's just the tricky thing. What were you going to say?
My bank gives me my credit score. What do
Okay.
they use? Do they use?
They will probably tell you, and if in the fine print, a lot of times they use a FICO 8 score, which is a little bit like Credit Karma. It's
Okay.
usually higher.
Okay.
But if you look in the fine print, even on Credit Karma, down in the fine print, it says it was computed using Vantage 3.0 in the fine print there. So look for that.
Is this bank credit score is reliable? How close it is to the mortgage?
I usually say it's about 20 or 30 points.
Okay.
In the bank stuff. So if you get it from Discover Card, Discover does
so
it,
Wells Fargo.
or Wells Fargo,
Wells Fargo.
or whoever's doing
Yeah.
it, the banks. I usually tell everybody, just knock 20, 30 points off, and that's going to be your average.
Right.
So,
Good run.
so on like Experian, right? So people pay for Experian, obviously.
Yes.
So when it comes to Experian, I know that it has rates as far as like it'll say auto, home. How accurate are those numbers? Is it usually the same?
So
Or-
you're saying that in Experian's
Yeah, I have a
program,
Yeah, I had a
they-
client show me that.
Okay.
They pay for Experian, so it says like auto.
They have
home.
industry specific scores. That's probably pretty
Yeah.
accurate if it's industry specific.
Yeah, I figure. I mean, I just did. I didn't know.
Yeah, not many people actually get a full product of experience.
I know they pay like a certain amount a month for
Okay.
that, but
Yeah.
That could be why. Yeah.
Yeah.
So Cody's identity, IQ, is very similar. The packet scores on there, pretty close.
Identity IQ. Which one's that? Is it just a different?
Identity IQ is a credit monitoring service that we actually partner with at Elevate My Scores,
Oh,
and so a lot of the clients that we, when we bring them in, we enroll them in that program, and it lets us see all 3 credit scores across
Are
the
those
3.
pretty close to the real FICO scores?
Yeah. Those are the 3 credit bureau scores, and that's pretty similar.
Okay. Those are the ones that Cody would be using?
They would be very close.
Yeah.
Yes.
As close as we can get being in different.
Yeah, being in different
You want to take one of our
industries.
classes?
Yeah.
Pretty close.
Right. So, and those, we talked about some of the names of the credit scoring models. So just in case you're familiar with that, Experian uses Fair Isaac version 2. All these kind of funny names. Equifax, you'll see Beacon 5.0. TransUnion is Classic 04. And, but those are important too, because then when underwriters are looking for, you know, which loans that they're going to underwrite, they will look to see where, what credit scoring models have been used to complete the credit scoring, and that's an important part of their underwriting approval. So, okay, let's move on.
Before you move on.
Oh, sure.
That last item, internet, did you cover that?
When we talked about Credit Karma, that was pretty much what I was referring to. Yeah. And when you see your credit score on, there's myfico.com. There's the freecreditreport.com. There's some other internet scoring models, and those we're all going to give you a different answer. Yeah. Okay. So the mortgage FICO scoring model has 5 different sections. The biggest section there is your payment history. It's 35%. Okay. So this is where all of your payments, all of your open and active accounts are computed in this section. So anything that you're paying on, whether it's a credit card or an auto loan, a boat loan, a student loan, a financial account, a personal loan, anything that you're making payments on, all of that is included in that major section right there. Okay, so one of the things that you'll see on a credit report that's really important is months reviewed. Okay, so months reviewed is an important factor in that it gives a snapshot of how many months of activity that you've had. Okay, so on an auto loan, every time you're making your monthly payment, that is a month reviewed, and then every month that you make a payment, that's another month reviewed, right? On a credit card, every month that you have activity where you're charging and making payments, that's another month reviewed. And the greater that number, the better you're going to score in that section, because it just shows the good, healthy payment history, that you're a person that makes payments on time and that you make your payments, right? So in this case, sometimes we'll have somebody ask us, well, you know, I've got some money, I can just go ahead and pay my truck off, right? That will help bring my credit score up, won't it? Yeah, I see some heads and shrugs. It may or may not, right? Because what's going to happen in the long run, you're going to miss out on all of those 60 months of activity in that month's review. That's going to help build your credit score in this section. So it is important in terms of an installment loan to make all of those installment payments, right? And to make them on time. Do you understand that? Yeah.
Okay, so I just had this happen to me. It was just because of the fact that my mortgage got sold.
Okay.
And while my mortgage was in limbo between the 2 companies, I bought a car. Of course. So my credit went down 70 points because I didn't have a mortgage on my credit report.
Oh, wow.
70 points. Like, that's, to me, I thought that was like way too significant. So I started asking all of the questions because I was like, well, what if I pay off the house? That means I'm not going to be able to get another loan for something else with that credit rating. So you tell me that, like, you should go into more debt and keep money on the side and not pay off a mortgage or a car?
So, and that's really confusing, because we get, you know, there are all these messages out there, Susie Orman and Dave Ramsey, that are all telling us, you know, that debt is bad, and you know, that I don't know that that's really the right answer. I think bad debt is bad, but good debt is a mortgage. Yeah, right.
Yeah.
Absolutely.
But I mean, before I bought the house,
right,
the credit was high. Why would it go down because you bought a house and paid it off?
Who knows what else is out there too? I mean, you know, there's so many. There are so many other factors that could be, you know, at bay there. It's really hard for me to say, because all of this, you know, is all of these averages and everything in this formula are so, you know, interdependent. So if you could for sure say that that was the only thing that changed, you know, that you didn't have a new credit card or balances changing or something else, you know, it would be really hard to say if that was the only thing. It could be that, you know, you said you bought a vehicle. So when you open up new credit, oftentimes your score drops for a little while. Any kind of new credit, a new credit card, a new loan, you know, construction loan or a vehicle loan, that inquiry and that new credit for the first 90 days or so will bring your score down. Now, actually, I'm going to talk about that a little bit later in the scoring model. So that could have also had a factor in it.
But this was when I was there, so it wouldn't have affected it yet because I hadn't got the loan yet.
Yeah.
Right?
They just pulled your credit.
They just pulled it, just to look at it.
Yeah.
Okay.
Without seeing the whole
But-
picture,
But basically the whole idea is keep a mortgage. And that actually works in
it's not, I mean, you know, a loan officer will tell you, as far as debt goes, the mortgage is good, you know, it's good debt to have, right? It's the least amount of interest, right? You're building equity in that, you know, you can borrow against that equity. It's not the bad debt like the revolving debt and some of those other things that you could have out there, so.
I was just curious as to whether there's a way to be proactive and maybe find out if an action like what you took, like to pay something off, is going to be a negative thing on the credit.
So loan officers do have simulators that they can use, and that will actually tell them, you know, if this happens, then that, and so actually there are quite a few clients that have some credit issues that the loan officer will go through a process of simulating, you know, well, if you paid down this card, then your score will come up, and so they have access to something like that. Yeah, so that's good. So let's move on to this next section called amounts owed. This is 30% of your score. And this is where revolving accounts are really important. You guys are familiar with what I mean by revolving account?
Credit cards.
Credit cards, right. So the balance can change, and like a revolving door, up and down and up and down, right? Unlike an installment loan where you're paying off of a balance over time, you know, 60 payments of $400, right? You know, that's an installment loan. But you can't go back and add to, you know, your balance, right? Because, oh, I need a new set of tires on that vehicle, so I'm gonna go add $1,000, you know, to that. No, you can't do that, right? So it's just, that amount is financed, and then you're just whittling it away over time. So in a revolving account, that's where you can pay off something and then charge it again, and then pay off something and charge it again. That's what I mean by it. So in this section, if you don't have an open active credit card, you don't score at all. Let me say that again. If you don't have an open and active credit card, you are missing out on 30% of your credit score.
Wow.
So the people that, you know, that say, oh, I just don't have credit card, right? And there are quite a few of them out there, then they're missing out on 30% of their ability to have a score in this section.
So I have several credit cards, but I only use like 2 or 3 of them normally. Should I be using all of them every once in a while?
So what we tell our, you know, when we do credit coaching with clients, we often tell them just to go out and spend something that like they would for cash, like a tank of gas or, you know, a little bit of groceries or whatever, and then pay it down. And then just to show that activity, because that is going to help you score in this section, is that activity.
I do that with my 2 or 3 cards. There's other cards that I have that I rarely ever use. Should I be using those or?
Well, you're not going to get any advantage, you know, to help you in this section from those cards.
Do you have balance on these cards that you don't use? Do you
No,
have,
there's no balances.
well, you need to have at least some balance on them and pay your monthly.
And that's a good point. So a zero balance is a good thing, you know, in our minds, because that's paid off. But actually, in terms of the credit score, a little bit of a balance is better. Not sure why,
So
but
should
it
you
just
pay the
is.
card down every month to zero, or, I mean, I've heard people
No,
say,
you
leave
need to
10
have
bucks on
some
there or something.
balance, yeah.
It's actually
And just
better
do the
just to leave a
minimum
little
payment
bit left on there.
every month.
Right.
What's that?
Just
Right.
minimal payment, like
Yeah.
you spend like $100 and you pay $7 each month.
Well.
You were gonna say something. No, go ahead. Are you sure? Oh, okay. All right. So, what's important here in this section is utilization, okay? So if you have a $1,000 credit card and you have a $900 balance on there, your utilization is 90%, right? Okay. So it's not necessarily a negative, it's just not as positive. You won't get as many points as you would get as if that balance was at $500 or $100, right? And we'll actually see a really big jump from that, you know, going from 90% utilization actually down to 50. So if we're working with the client and they're trying to get some things paid off and they say, you know, I just can't, you know, make those big payments. Well, just that little jump from 90% to 50% can make a big difference. You don't have to pay it all off completely. It's more of a bell curve. It's not necessarily just a straight percentage there, but it is better to have lower utilization percentages for your credit score in this section, right? So, just to kind of wrap up this, it's important to have open and active credit cards and to keep the balances paid down low, not necessarily zero. Having a maxed out card is not as good. It's not a negative, but it's just not as good for you, right? And but then of course having a card over the limit is a negative, right? But not right at the limit necessarily.
Does what you pay as far as over minimum, does that factor in at all? Like you pay more than a minimum balance, or?
It's all going to help you in the long run, you know, get that utilization down, because when you're only paying the minimum, you're just barely paying that interest and not necessarily, you know. I noticed that in my Capital One credit card phone app now, when you go to choose the amount that you pay, it'll tell you how long it'll take you to pay it off right there on the app. If you make that amount of a payment, and then there's like a little scale, and so you can move the scale up and down.
Any factor?
Not necessarily.
Okay.
No. But this is one of the areas where loan officers can, like I said, with those simulators, can make a big difference, because they can take someone and put them in the simulator and say, okay, if you paid your balances down to X, then it's going to bring your score up. And a lot of those types of clients, they just need that little bit of coaching and a couple of months to get that down, and they don't ever really have to enroll in full-on credit repair. And those are not the clients that I would, you know, recommend for our program. They you know, like I said, just a little bit of coaching, and loan officers like Cody and his team are really good at doing that. To have to, but then of course there are going to be some people that really could benefit from the full-on credit repair that got more complicated issues, collections, student loan issues, and so some of those things are the types of people that we absolutely.
How would you handle a client that never have had any credit cards?
Like building credit. I'm going to talk about that a little bit later about what to do. And that's certainly an issue for, you know, young people. For sure, people that are just starting out. My own children are in their early 20s and you know, getting to that age where I want them to be able to. So that's something that I've thought about a lot too.
How long does it usually take to get them to like credible credit score?
Well, when we get through talking about the FICO model, I'm going to go into building credit, and we'll talk about it at that point. So. So the next section here is length of credit history. So this is an average. This is really important to understand here. Of all of your open and active accounts, both installment and revolving. So in order to maximize this section, you need 25 years of average credit history. That means that the longer you have a specific trade line, the more it's going to benefit you here. Okay? And this is a section that we really look at closely when we're doing credit coaching with clients. Clients who often come to us and say that, well, I thought it was bad to close down an account. Well, the answer is maybe, okay? Because it's an average of the time that you've had those accounts open. So let's just make an example here. If you had a credit card, a MasterCard that you've had for 10 years and it was your only credit card, and then you go to open an Old Navy credit card because you're going to get a coupon, right? Right? They offer that to you all the time, right? So then you have 2 credit cards, and your average went from 10 to 5, right? Okay, so that's what I mean by it's an average, right? So if you have more than one credit card that is active, that we call depth of credit, that can really be an important thing here, so that opening up that new account won't hit your credit as much as it would if you just had that one credit card to begin with, okay? Does that make sense? A good way to explain that? Mm-hmm. So another thing that we can, I don't want to say manipulate a credit score, but certainly can be something that can be helpful. I just worked with a client who was working to get a cash out refi, and was working to get her score to a certain point, and we had worked, and then she had the opportunity to be added as an authorized user. You ever heard the term authorized user? Okay, yeah. And so what happened is then she inherited all of the length of credit history of that card, and then it helped her in this section of the scoring model tremendously. And it was enough to bump her score up to that next section, and she could qualify for that next tier of credit to get the cash out refi. So that was an important thing to understand in how we could help her. But that is actually one way you could help a young person who doesn't have a lot of credit to build credit for them, as long as whatever you're adding them to has that length of credit history, right?
Is that still called piggybacking?
Yeah, I guess you could call it that. Yeah, I was just it's authorized user is the industry term that we use, right? But parents will often do that for their kids going off to college, right? Add them, to a card so they have an emergency fund, right, to use or whatever if they're away from home, that kind of thing. Lower the credit limit, right? Don't give them the one with the big credit limit. But we've actually seen that happen, like a 20-year-old kid that has a 25 years of credit history, right, that they inherited because they were added as an authorized user to that account, right? So that's just an important thing to know, right?
Do you also take the debt? The debt automatically goes into your equation.
All of the information from that, right? So the utilization, the payment history, all of that is factored in there. Yes. So it can help someone or it could hurt them. It just needs to make sure that whatever they're being added to is something that is beneficial. Yeah.
So does it have to be a family member, or can it be a friend?
I believe that's up to the credit card company. I don't think it has to be. No, it could certainly be significant other, friend, whatever, business partner,
Whoever you trust enough to put your name on there.
yeah. It's like you're co-signing, for them, right? You're taking on their spending habits. So, you would have to be certainly somebody that you trusted, right? So, there we go. Okay. Next section is types of credit. So this deals with the different types of accounts on your credit report. It's helpful to have a good mix of credit. Ideally, we say about 3 credit cards for every 1 installment loan is a good balance of credit, and that's what we work with our clients to help them on. It can also impact you negatively if you have too many of any one certain type of account. And so, for example, we've actually had a client with a reason code that said too many store cards. So this particular client had over 20 different store cards. She was from Dallas and lived by the Galleria, not to pick on Dallas, but I guess that might be like living by the outlet mall, right, in Central Texas for us. And she had, just all the way around there. And they were open and active and paid on time. They had high balances, but, we were able to work with her to pay down certain ones. We were very strategic in how we coached her to leave open the ones that had the longest credit history, right, and then to close down the ones that were the shorter ones. So then that helped her in that length of time. But then it took a few months for that reason code to fall off of there. But so that can be something that shows up on. We also see a reason code sometimes too many financial accounts. So do you know what I mean by a financial account?
Like loans, leases, car leases, student loans.
Yeah, probably more like One Main Financial or Sun Loan, some of those float loans, the high interest, like Rise Financial, those types of things. They tend to be a little bit predatory with people with lower credit scores, but a lot of people will get them to float themselves money-wise from paycheck to paycheck. Yes, payday loans can certainly be in that category. These are some of them are not secured. They do have products that are, but they're still a super high interest rate. Yeah. And so if a client has, even if they're paying them off, but if they're in the habit of using that on a regular basis, and develop that habit, they could get that reason. Although even though they're paying them and are showing a good payment history, they could get that reason code that says too many financial accounts. And we've worked with a client that actually had that. And when we delved into what was really going on there, she was just in that habit of going out and getting that little float loan. And then paying it off, and then she'd get she was a teacher, we got paid once a month, so she was using that to stretch, that last little bit of the month. And so we just worked with her and helped her kind of build up a little bit better spending plan and get out of that habit of having those float loans. So, somebody have a question? Yes.
When you close an account, does that affect your credit?
Maybe. It depends. If you close a credit card account and you've had it for 20 years, yeah. But if you've had it for 6 months, probably not, right? Do you understand the difference there? It'll depend, and because all of those are averages, and that account that you've had for 20 years is really helping you in terms of that average, right? So that's the important thing there. So there's no right or wrong answer there for sure. Then the last section here is new credit. This is where this section is a little bit different, is that you start with all your points and work backwards. And then so points are taken away for inquiries and for new credit. You're familiar with what I mean by an inquiry?
When they pull your credit.
When they pull your credit, okay. So when you're using a service like Identity IQ or Credit Karma, that's not a hard inquiry, that's a soft inquiry, and so it doesn't have any impact on your score. That's an important thing to know. But when you're applying for a mortgage, an auto loan, a financial account, a personal loan, credit card, those are all hard inquiries, and they do impact your credit score. So, and the reason is that this is so important is that the highest rate of default in new credit happens in the first 90 days of opening an account or getting a loan, okay? So, the model kind of hits you really hard at the beginning of for that inquiry, and then over time, the impact of that inquiry decreases, if that makes sense, okay? So about 3 to 5 points for every inquiry are what we see generally, and especially at the beginning. But then it takes 3 to 4 months until you get those points back. They'll still be reporting on there, but they're not necessarily affecting your score at that point. Okay. So have you ever heard of the term shopping windows? Okay, so
Oh, mortgage.
window shopping, right? Yes, and so that's when you're shopping around for the best rate, okay? And so you're going out and you're shopping around trying to find the best mortgage rate or the best auto loan, right? And if all of those inquiries are done within a period of time, usually about 14 days or so, depending on the industry, then all of that counts as one inquiry. It's like you shouldn't be penalized for shopping around to get the best deal, right? And that is usually true, except in some industries it can really be difficult to make sure they're all coded so that it is only truly counting as one. Now, in the mortgage industry, it's not an issue. They tend to be a lot more careful about how those inquiries are coded so that when that batch of inquiries shows up, then they're all coded as mortgage, and so that will count as one. But at a car dealership, it's not the same way. So just for example, when you go to like Nall Maxwell and you're going to buy a vehicle, right? And they do what they say they're going to like try to find you the best financing, right? Some of the places that they're going to apply to on your behalf will be auto loans, like Ford Motor Credit or whatever, or they also might be banks like Wells Fargo, or they might be a finance company like Ally Financial, right? But companies like Ally Financial don't just do auto loans, right? Wells Fargo doesn't just do auto loans, right? So that's where the tricky part can come in, right? So a lot of times when you're doing that blast and cast at the dealership, it's waiting for it to stop, right? When you do that blast and cast at the dealership, some of them will show up as auto, some of them will show up as financial, okay? We had a client that was looking to close and had been given the okay by the loan officer to go ahead and buy this vehicle, went to one dealership to buy one truck and had 14 inquiries, right? So and it should have counted as the shopping window because we thought, well, the shopping window should condense into one inquiry on his behalf, right? But what happened is then 4 of them were coded as auto, the other 10 were coded as financial. And it wasn't his fault necessarily. So we had to work to get that cleaned up and get those inquiries removed, and we were able to do that. But it's just an industry thing. So you always hear when you're starting that relationship between your client and a mortgage officer, don't go out and buy anything. Don't go apply for anything right now. And that's part of the reason is just to make sure that nothing hits your credit like that. So it's probably a good time to take a little stretch break. I know we've been sitting for a few minutes, and then when we come back, so let's take a 5-minute break. If you want to get another cup of tea, another sandwich, or something like that, and then we'll start back in about 5 minutes, and then we'll talk about building credit, and we'll go into a little bit more collections and some of the negative things that can affect your credit score. So let's get and stretch. Walk around a little bit.
Any questions anybody wants to ask or throw up right now? While we're doing a break? No? Okay.
The pen, it's everything but that. So I'll just tell her I'll send it later this afternoon, and then, I got an emergency thing from Martha. Did you get it?
How do you guys determine how much
You know, I don't know if
I
it's
spend
show me on the map, Mark.
based on
I wonder if you got an accident.
and what they owe on their credit card and stuff like that?
All the brother?
Here's my
Oh,
brother.
yeah,
That's
so
my
I'm
brother.
here.
Brother.
I'm James Espinosa. Yeah, I know about the same old, Eric.
Erica, yeah, she's down in Houston, yeah.
Oh, okay.
Same like that.
Well,
Yeah, okay, tell her he'll have to stop the electric comments.
I guess, I mean, it looks like they're pretty close.
We're gonna write that.
I have, I
Offer
can go up
to.
to 56, 70. I think that's
Depends
more
on,
money than
yeah,
usual.
yeah, it kind of depends on, you know, what program
Yeah.
you're trying to do. It's definitely, you know, but yeah, I would show.
Oh.
Yeah. That's right here on the board there. They are.
I'll go with you. I'll go with
Their email, credit scores, it's not
Single guy or married?
Are you okay? I got an SOS from your Well, I know, well, you have an emergency button on your phone. Sometimes I it showed North Lamar or something. I've got to get that review at a class. We're in Buda at a class is well, right? So I just wanted to check on you, but I'm gonna run, get back in there, but, no, it's okay. I've done it. No problem. Glad you're okay. All right. He's fine. Yeah, let me show you what it does. I can get in there and I can look. Something I can. So I go in here. Oh, wait.
very old. So that's just, so those people, the whole
I'm going to go into full site and change This is so cool. The whole and then I get there, set it on. I'm gonna have to switch.
overall average.
So here it is.
I wish I could say that, because it's the entire year,
That's pretty awesome.
The guidelines are supposed to be whatever is better.
I just got
They're elderly, and they live the house by themselves, but they really should be in secure, maybe safer, a community, or, we can still put about 300 hours, but I'm not sure that they would qualify. Some of them, I sent Sun City, or maybe even in Beach. There's some in places
necessarily one of the
Yeah.
things we can do.
Yeah.
Divide it to where then-
Something about something certification class, right? And so,
Yeah.
Well, the price of per training is,
So there's not a couple.
not really. To start here, it's tremendous referral, certification.
it's only like 3 days of classes.
LUIS, right?
This is how many miles away they should be.
I would say usually before you sign up,
It used to be Prosper Properties.
it's easy to go up to the
Bruce or Harlan.
Yeah, well, he just was legally blind. This is, and, we still, this is going to get that. Not just a credit. So like you'll only go last week.
Good plan.
So where's your office?
It was different. It was pretty expensive.
I'm not recruiting. I'm not recruiting.
You are too.
I'm just talking.
He's a good guy. He's trying to get something out of it.
That was kind of. Yeah, they're pretty much got
Who do you work for?
I was sort of. There's somebody I know probably. Rachel, maybe. But. I know Kathleen. That's pretty interesting.
Yes, it's not even going to do that.
All right, let's go ahead and get going again. I want to get you guys out of here on time.
Oh, yeah, I have to wear
Dad, give her a hard time.
Okay, let's talk about building credit. That was a question that we had already today. How do you build credit? And this is really more from like starting from ground zero, you know, a young person getting started out or someone who has no credit. But what advice would you give? So 2 to 3 credit cards is a good place to start. And for someone that doesn't really have any credit, how do you get a credit card, right? Because so a secured card is a great way to start. And you're familiar with what I mean by a secured card. It's not a prepaid card. And there have been some, now with so many was actually, we didn't think that this was that much of an issue, but we've had a client that got a secured card and thought that it worked like a prepaid card. And so she put the $200 on there and then spent it down and didn't think she had to make a payment. So a credit card is a credit card, right? So it just means that you're making a security deposit in that bank, right? That will give you that line of credit. So here's a great secured card that you should know about. Open Sky Visa. Open Sky Visa.
I think it's openskycc.com.
It could be.
I
Yeah.
think that's the website.
If you Google Open Sky Visa, you'll find it, and I think Cody says that address is openskycc.com. So the reason why we recommend them is that they don't check credit at all, okay? So you can get a secured card with them without a credit check, okay? The beginning balances are as low as $200. And their fees, their annual fees are very reasonable industry-wide. I think it's like $39 a year is what the fee. So if you've looked at secure cards, that annual fee is a big issue there. So and then their interest rate is also very competitive. I think it's 16-17%. So that is a great way to start. So often, if we're working with someone who's building credit or who has really low credit, and we're looking to help them build some of their good credit, we will start with Open Sky until they get their score built up into the like upper 500s, and then they could qualify for Capital One has a good secured card program as well. Discover Card has a secured card, if you weren't aware of that. And then of course a lot of your banks will have secured cards, Wells Fargo, Regions Bank. But I wouldn't recommend those unless your client is in that in that range where they could qualify for that. If they know they're that low, then Open Sky Visa is going to be the way to start. Okay. And then making sure that you understand the difference between revolving accounts and installment accounts. I know we've talked about that a lot. So an installment account, that is, of course, your auto loan, a mortgage, a student loan, all of those things that you're making those regular payments on. Okay. So identity theft and errors. Which do you think is more common, identity theft or identity errors?
Errors.
It's errors. That's not what LifeLock wants you to believe necessarily. With their commercials that try to get you to sign up for all that and everything. But so a study has shown that 70% of credit reports have some sort of negative error on them. But more than likely it's because of an error, not necessarily identity theft. Although identity theft is out there, and let's just talk about some of the types of identity theft. This is when someone steals your ID account for financial gain. So we always recommend a credit monitoring service. The one that we use, that we partner with our clients, is called Identity IQ. And when we bring a client into our program, we'll get them enrolled with that. It also has fraud protection built into it, $1 million of fraud protection insurance that's built into that account. It's a $19.99 a month charge. But when you're working with someone and educating them about their credit, it's a good way for them to be able to look at their credit, all 3 credit scores on a regular basis. But then it also has that fraud protection built in. So there's several different types of identity theft. There's mail theft. So this is, when you're, maybe you're getting your mail at the driveway instead of in one of those lock boxes, and then people go through your mail and take a credit card or a bill or whatever and get your account numbers and utilize it that way. Pre-texting. This is not something that you do before you text. Pre-texting is where someone has a little bit of information about you and then they use that as a leverage to get more information. So for example, maybe if somebody knows that you went to the University of Texas and they call you and they say, hey, we're having a UT scholarship fundraiser right now in the Buda area, and it's a fish fry, and we wanted to know if you would donate to the scholarship fund for the area, right? But it's not really a scholarship fund. But they use that information knowing that you were a UT alum to get more information from you, right? And we see pretexting a lot in senior fraud. My mom got a call that someone said, hey, this is your grandson. I'm in New York. And I ran into some trouble and I need $400. Can you send me $400? And her grandson was playing a baseball game in Georgetown. So at the time, right? And so that was, obviously someone tried to utilize some information to get their foot in the door, to get leverage to abuse someone in that situation. So that does happen.
I don't have a grandson.
Well, right? How did I know? Right? Probably from Facebook. Who knows? So, phishing was where a message is sent to you, please contact Wells Fargo immediately, to verify your information. We think there's been some fraudulent activity on your account, but I don't have a Wells Fargo account, right? So you get those weird texts, and that's what phishing is. Okay. Breaches are obviously when a company's records are compromised. We've heard that with different retailers like Home Depot. Who else had a breach? Target. Yeah, I know there was. I was getting a new credit card, like a new debit card, over and over and over again. It's because of that. All that used it at Home Depot, used it at Target, right? Because of those breaches. Dumpster diving is obviously a thing. Although I can't imagine digging through the yucky trash to get to that, but that's why but people do that. So that's why a shredder is still an important thing to have, or just to use paperless billing, right? And not have those papers. Shoulder surfing is that when someone looks over your shoulder to see, if they can see your PIN when you're typing it in. So that's why you'll see a lot of people protecting their hand when they're typing on a device with their PIN. And then skimmers have been a really big deal. Anybody have their information stolen from a skimmer yet?
No, but I have friends that have.
It just happened to me last month. Yes.
Wow.
At an HEB gas station of all places, and I got a call in the middle of the night, or a text that came in from Compass Bank, and they said, hey, did you try to authorize a $400 and something online purchase at Cavender's? Oh no, and then it's like, and the only place I had used that card was at that HEB gas station. I had actually swiped it. So it is a thing. So what they tell you to protect yourself from that is that if you're using your gas, your debit card at a gas pump, to always run it as a credit. Don't type in your PIN number, because if the skimmer is getting your number, your credit card number, you don't want them to get your number and your PIN, right? Because then they have unlimited access to all of that. So be super careful. I even have clients that say that they'll just go inside the store to pay instead, and prepay a certain amount inside the store, or use cash. But if you think about how that has gotten to be, such a big deal. The gas pumps are outside all night long. Somebody can come by and jack with it, and it happens for sure. It is amazing the different creativity of people.
What's the remedy for that? I mean, if somebody gets your information, does the bank?
They didn't authorize the purchase because they, saw that it was, obviously in the middle of the night, and it was just not a spending pattern that I had, and so they didn't authorize it, and then they shut off that card immediately, and I was able to go to the local branch and just get a temporary card until a new one came in the mail. But that's
like your average college kid, who uses the debit card, and that happens to them.
I would would say, you know, I've counseled my own kids that all have their own bank accounts and debit cards, that not to run it as a debit at the gas pump. To just run it as a credit card. When it asks you, is this a debit card? Just hit no. And then,
Can they affect you if you use a fleet card? You know, where you put in a driver ID?
I don't
And then it's
know.
connected to a bank account through that. Is that an extra? I'd like to know.
That's a good question. I don't think I know that much about how that system, that processing system works to be able to answer that. But that's a good question. I'm gonna ask Chris. He'll probably know. He knows it all.
Are you able to like reverse the charges that you are not agree?
Your banks are usually very, very quick to do that and freeze your account in that way, and then get
How
those.
much of the window do you have? Like, for example, I noticed that 3 days after it got stolen, and it's already been like that many charges.
No, you shouldn't have any problem going back to them. Yeah. But it is important to look at your money every day, right? You know,
Every day.
Every day. Yeah.
Well, so like, I don't know, I have alerts on my phone, so anytime someone's charged over $50, I had one time $50 gift cards right before Christmas. It's happened already twice this year on other Visa cards. So.
Oh no.
But anyway, so one thing is to have the alert set on your phone,
Yes.
so that if
Yes.
someone
And
the airline tickets to Germany once this year.
I had someone trying to check into a hotel in Atlanta when I was at work in Georgetown. Yeah.
But they've always
Yeah.
covered the
Yeah.
banks always
Yes,
reverse
absolutely.
the
They have.
charges
They
right
have.
away.
Mhm.
So it's never been a problem.
Yes.
It's an inconvenience because then you have all the credit cards,
Yes.
you have automatic. It's an inconvenience. But
And anytime you have an account that wants you to engage in two-step verification, set it up. And that's usually when they have your cell phone number, and then so if somebody's trying to log in on the internet and they've got your card and they're trying to manipulate and get into your account, they would have to be able to also have your cell phone number, handy. So, so if you have anytime that you even if it's a social media account, because if you think of all the things that are tied to that information, two-step verification is really important in making sure that it's you that's accessing those accounts or that's those things. So let's talk about some types of identity errors. If you have the same last name in the same zip code, often we see that those accounts can merge. I know that sounds really strange, but it happens. Jones and Jones in 78628, right? Martinez and Martinez and 78633, right? That could happen, right? If 4 letters in the name match and with also 7 out of 9 social security numbers, the files can merge that way, right? And they could be across the country. So true story. We had a client that was determined to tell us that there was an account that was a fraudulent account on his credit report, right? And so as we looked at this trade line, it was a Chase account that had several years of good payment history and a 50% utilization, right? So this was the most honest thief ever, right? Because a thief probably wouldn't be making regular payments on that trade line, right? But it turns out that it was this type of a situation. The gentleman's name was Robert. The trade line belonged to Roberto, and they had 7 out of the 9 social security numbers the same.
Wow.
Right. So that can happen. And of course, juniors and seniors have a lot of cross-reporting as well, right? My son-in-law is Marcus Collick Jr. and his father is Marcus Collick Sr. So they've had some issues with that, but that happens quite a bit. Okay, going the wrong way. There we go. Okay, let's talk about the types of negative items that are out there. Collections, bankruptcies, bankruptcy items, so accounts that have been through that bankruptcy process, charge-offs, profit and losses, inquiries, we talked a little bit about that, tax liens and judgments. Medical collections are actually very easy to have removed. We use the HIPAA laws to help us with that and get some leverage to get that, because often not all of that information is out there, and so if they can't verify all of that, then it has to be removed. So medical collections, we always, when we're enrolling a client in our program, we'll often ask if you have any medical collections, because that can be something that very easily can be removed. Divorce-related issues, so child support collection can be a negative item there. Identity fraud, foreclosures, repossessions, and of course any and all late payments can all be negative items that are on a credit report.
What's the latest on foreclosures? How long does it stay on your credit?
I'll let Cody talk about that.
Ooh, I've seen it on there actually past the 7-year mark. I've seen them on there. As far as loan products go, it depends on which type of product you're doing. If it's going to be conventional, you're going to have 7 years. If it's going to be FHA or something like that, USDA, it's going to be 3 years. So if you have somebody with an issue like that, usually that's why, one of the reasons why we're going to FHA as opposed to.
So even if it stays on the report, as long as it's been there 3 or 4 years,
If it's still on there, but it's already, the time's passed.
then it's okay.
Is it the same for the collections too?
Collections are okay. No, credit score is one thing, but then actual getting approved, totally different, 2 different things, right?
Right.
We can have somebody with collections. It depends on if it's over $2,000 or under $2,000 in total collections. The way the underwriting guidelines are written depends on which product, VA, FHA, USDA, conventional. But when they have thousands of dollars of collections on, say we're doing an FHA loan, just because the majority of the time that's the loan we're doing for somebody in that kind of situation, we'll have to count 5% of the total collections as a monthly payment for it. So charge-offs do not count. Collections do. Medical does not count. Collections do. So if a credit card gets charged off, but they have a broken lease that shows up as a collection, we're counting that lease $3,000, so $150 there.
What if the collection is paid off, but it still shows on the?
Usually we'll get a letter. We'll ask the buyer to help us get a letter from whoever they paid. And that's usually one of the things we'll do to update it and get it removed.
Right.
And sometimes, I don't know if you've already covered this or not, some collections are old and we don't want to update it. So we don't want to bring it current.
Right.
Yes.
Yeah, no, we're just about to talk about that. Yeah, no, that's a really good point. So, when we talk about collections and the different types of collections that are out there, this is where the advice of a loan officer or a credit professional is so important, because the idea that a lot of people have is that, well, I just need to go pay all those collections off and then my score will go up, right? But that's not necessarily the case. And it's not that we're telling you, well, don't go pay your bills, right? That's not it at all. But if you're in this situation and you're working on, getting into a home loan, you want to be careful about how you do that. So if you have a 4-year-old collection, okay, you haven't had any activity on it in 4 years, it was from a DirecTV or whatever, and then you make a payment on it because they're calling you and harassing you. Now it's a new activity and it's a new collection. Okay, so it has less of an impact if it's an old collection, right? And it has, fresh impact if you're making activity. So an example of this is had a client that was, had found the home of her dreams. She was a single mom working to sort of rebuild her life, and got a call about a medical collection, okay? It's an $800 medical collection, and the collector said to her, I know that you're not going to be able to close if you don't pay this collection. Yes. And so I'm going to do you a favor. I'm going to let you settle this for half price today. You pay me $400 and then you'll be able to close. She did not call her realtor. She did not call her loan officer. She did not call her credit professional. She was just, kind of made that gut reaction and sent the money. And then what happened is then that was a new activity on that collection, and it dropped her score to the point where she couldn't qualify for the loan, and then lost the opportunity for that home that she wanted. Now, we worked and, you know, remedied it so that she could get into another property a little bit later. But it was just so sad, you know, to be in that situation. And that's why why we're so passionate about making sure that you understand this information too. So when you're working with clients in this situation, so they know, don't pay that off. Call and ask us a what if question first, and then we'll give you that advice. So
How would they collect their note that she was
They run their credit.
they run their credit, yeah.
Mortgage
check.
inquiry. They'll see the mortgage inquiry and they're like, oh, you're buying a house.
because they have access to her.
Right.
Well, that's smart. But sometimes they follow the collection.
And because they can get reports, they might not be pulling their credit to
But
do
they
it,
can
but they
report
can
short
get
about inquiries.
exactly.
Yeah.
Yeah, for people that are on their list of people who have collections, they might get notified in the mortgage or part inquiry.
Okay.
And like Cody mentioned, some of the collections that are out there, they may not hurt your credit score as much as they might hurt the underwriting process. So if you're trying to get a government loan and you've got a student loan collection, right, then that's going to show up on that CAVERS report, and that's going to keep you from being able to qualify for that government loan. If you have a housing collection, like from an old apartment complex or something like that, when you're in college or whatever, and that's showing up, you know, that could hurt the underwriting process. So it has two different impacts there, to the score, but then also to that. So
What about if the collection gets sold to another collection agency? Is it considered a new activity? Is it another 7 years?
No, it's not another 7 years. So technically it's not supposed to be, and that's where they'll come in and they can help argue that or dispute or whatever you guys do when you're getting rid of stuff or cleaning stuff up. Because they'll go back to the original date and say, hey, from the original date, this needs to be removed, even though it just got sold 2 years ago. So.
good point. So I'm gonna let Cody talk a little bit more about his programs, and this is a good chance for you. I know there was some, when we had that break, you guys were asking some good questions about, well, what about this and what about this? So it's a good time to bring him up
on this, I
to
just
talk.
kind of wanted a couple quick things, just because focus on credit scores still and just credit in general. So on FHA, with us, and I think pretty much everybody has about the same guidelines. On FHA, we can go down to 580 on a credit score with just 3.5% down, so 3.5% down payment. We can go all the way down to 500 on a credit score if they have a 10% down payment. Usually when you have a 520 credit score or something like that, we've closed several of them where somebody was selling a house, they made a good profit on the sale, they rolled $30,000 down on the down payment and closed on the next house, no problem, right? So it's actually doable. It's tough when they don't have any money, but you can't do a 520 at that point. VA, technically we can go down to 500. I haven't really, it's been a while since I've done one below 580 on VA. Just because VA is a little pickier on, usually there's a reason they have a 520, it's because they've been late on everything. So if they're late on everything, then they're not getting it. But if there's something specific, the last time I did below 580 on VA was because somebody got divorced. In the divorce decree, it specified that X was supposed to pay these bills that weren't getting paid. And so we did a manual underwriting, got it approved, because we were allowed to exclude all that debt that the spouse was messing up, basically. So there's options for that. Conventional loans, that's where you're gonna need a 620. So, and that's just a Fannie Mae Freddie Mac rule. 620 for convention. Yeah. So, what was I gonna say? Down payment assistance. If you're gonna do any type of down payment assistance, it depends on the program. There's like 15 different programs out there, but they're all gonna have different levels on what the scores need to be. The lowest one that I know of is 620 on down payment assistance. I don't know one that's doable with 620. I keep looking, but I haven't found it yet. So 620, some if you need more money, 640 if you need a better rate, 660, whatever it is. But so that's for your down payment stuff. Any questions on anything as far as credit goes on mortgage stuff?
What's the difference in rate on FHA at a 580 versus 620?
Between a 580 and a 620 might be the difference between say 5.25 and 5.625. right now. So if anybody hadn't noticed, rates have gone up a little bit, right? Yeah, like those kind of 620, 580, like everything's in the fives if you're in that lower end of the credit score range. So if you're still in the good higher end range, you might be able to get in the higher fours, 4175 or something like that.
So 620 or 640, is that the best score to have for the best interest rate?
Oh no, ideally you want to have something in the 700. So yeah, so at the lower you start going in the scores, the higher you start going in the interest rate. So basically it's
what's the minimum score that you should have to hit to get a decent score? 640 or higher?
yeah, I mean 680 would probably be better because at 640 you're going to get a slightly higher interest rate than you would at 680.
Okay.
So assuming you're just talking about FHA,
Yeah.
because conventional is even pickier. FHA and V are very similar on their pricing adjustments for credit scores. So 620 FHA, 620 VA is going to be the same. But conventional 620, that's going to be a lot pickier. It depends on down payment as well too for conventional, whether it's 3%, 5% down, or 35% down. So,
Do you do jump loans? Is it still 720 for jump loans?
no, you can go below 700. Again, the lower you go,
Yeah.
slightly little bump up on the rate. So usually what we'll do is we'll try and work with the borrower on just doing a rescore. It's sometimes it can be so easy to get a quick 40 points, and I can take their rate from 5.25 to 4.75 by just paying off these 2 credit cards, and they got all the money in the bank. I can see it. Just pay it and send me the credit card printout. It's a couple days.
So Cody, how familiar are you with the grants that are out there? And
Which
how
ones?
often do you?
Like T-Shack or something different,
Yeah.
or we do a handful a month, every month, so we'll probably do 40, 50 a year.
Like teachers?
Teacher stuff, yeah, the teachers, the veterans, the firefighters, all the different, that list on T-Shack.
Okay.
So yeah, we've got lots of we can do all those programs. So Travis County is, go ahead.
MCC?
Yeah, MCC, yep. And so MCC, I mean, that's usually, we're doing the MCC for the first time buyers. Usually that helps with getting them approved for a little bit more for the debt to income ratio, because I can get that $167 added to their approval amount, so $167
What does that
is
stand for, MCC?
mortgage credit certificate.
Oh,
Mortgage certificate, credit certificate.
Qualifications for instance.
First time buyer, 620 score, VU approval, underwriting approval.
It can't be a VA loan, right?
Yeah, you can do VA. Yeah. You can combine it with FHA, VA, USDA, conventional. Any of them. So it just can't be can't make too much money. There's an income limit too, but not having people in the family.
In the last 3 years, you can't own a home. But,
Can't own a home.
Yeah, but you can have owned a home before, but not.
Yeah, 5 years ago, whatever, you're fine. Because we have to turn in 3 years of tax year to show that they didn't have any mortgage interest on it.
Is there a fee that you have to pay for MCC?
There is, yeah. It's I want to say it's $700 now.
Not just a flat fee?
Well, it's a $500 MCC compliance fee, and then they charge a $200 something review fee, MCC review fee or something, whatever they want to call it. I just tell them it's $700. So.
Okay, but just a sort of a one-time?
Yeah, it's a one-time fee.
Oh.
Yeah. So
But the MCC is for the length of the loan
yes,
every year.
yeah, every year. So they're doing credit on their tax returns, and then they're adjusting their W-4 on the withholdings. Well, usually we tell them to. I don't know if they do or not. So.
Oh, so it's like a credit, it's not after the fact. I'm trying to figure out how to take advantage of it.
It's a credit on your tax returns.
Got it,
So
okay.
if anybody wants to, send me an email. I can send you a little link to kind of like the frequently asked question page, and it does a specific example for a $200,000 house or something. So
So if you took that MCC class, does that take away the $700 or is that in addition to?
you got to do the class.
You gotta do
anyways.
both.
Yeah.
But I've heard that milestone sometimes covers the class and the.
If you just say, hey, you guys pay for that
Yeah.
MCC fee, they'll say, okay. You got another answer. So little secret tip. They'll pay for it. Anything else?
Just a quick blur.
Sure.
Interest rates, you just see them go down.
Yeah, I hate saying it, but yeah.
What
you
is
know.
the dynamic? What is your forecast?
I would expect everything to be pretty much in the fives next year. So by the time we get into the spring kind of buying season, I don't know if you guys kind of follow the waves up and down, but we'll probably finish the year strong in December and sell all these inventory homes, right? Because they'll give a bunch of discounts. January and February are kind of slow for us, but then come March, it's like explosion of home purchases, and that's about when the rates are going to be like, oh, it's 5 1/4, and you're like, oh, all right. But as long as rates stay below 6, anything in the 5s, I don't know how long everybody's been doing this, but even rates in the 6s are still fine, honestly. But
We used to do them all the time.
yeah, I know, right? People are still buying houses, not that long ago. But rates in the 5s still mathematically make sense to buy as opposed to renting. So it's still, again, I can sit down with the buyer or anybody that has to have the discussion financially and mathematically say, yes, here's why it makes sense to buy at 5 1/4 or 5 1/2 or whatever the rates are next year. So yeah, it's still gonna be a great time. As long as jobs are here, it's really all about jobs. Rates don't really matter. It's not gonna, might get a few people to not wanna buy. Usually millennials, I think that rates are 2.5 or something, 3%. So, they'll eventually come around. But as long as jobs are coming to town, people are moving here, we're good in real estate. So it's all about the jobs. I'm still gonna be hanging around if anybody wants to ask a question about it.
That's great. I'm gonna just got a little bit more here. So, big picture, you know, I really appreciate Milestone and NRL for sponsoring this today and letting us come in. You know, it's just great for all of us and helping get the word out there about credit, about how confusing it is, and you know that you could use that information to help a client. It's good for us too if you would in turn let us know what you thought about the class. We have a Facebook page. I did a Facebook Live today. My phone's sitting right over there, so that it would be out there and in the queue of Facebook. You can do a Google review, a Yelp review. All of those things would be helpful. If you were to do a review for us, we would give you credit toward an upgrade in our program for yourself or family member or a client. So when you look at our program on that card on the back, there are 3 programs that we have. We have the standard plan, we have the plus plan, and the premium plan. So the standard plan, you know, if you paid for that, then we would give you an upgrade to the plus. If you paid for the plus, we would give you an upgrade to the premium. Right?
Can we go like this and comment on Facebook?
Absolutely. Yeah. As long as it's in there. They do have a review. So if you go to straight to our Facebook page, you can do a review with the stars and leave a comment there as well. We would appreciate that. Okay. Kind of helps us in the ranking. But just to talk a little bit about our program specifically and as it compares to the rest of the credit repair industry, Cody mentioned, and I appreciate his good feedback about that. We really do feel like we stand out in the industry in that we have very affordable programs. When you refer a client to us, basically we give them a $50 discount on our program. So normally our program is $100 to get started, but if you refer them to us, we'll give them the $50 rate.
$100 per month?
$100 per month. Mm-hmm. And in the credit repair industry, some companies will charge by item that they delete. And so that can be very costly if you've got a client with lots of different negative trade lines that they need to have deleted. So for us, it's a monthly fee, and so it's not based on the amount of work that we do necessarily, okay? In our standard plan, that very lowest cost plan, we go through half of the negative items every month when we're sending out letters every round. So if someone has 20 negative items, we're going to send out 10 letters on their behalf. Our competitors will send out 3. And so we feel like even at that very beginning level, we're already providing more service for the cost. And then in our plus plan, that middle of the road plan, we do unlimited investigations every round. We're going after every negative item every month. and that's just not seen out there in the industry. We feel like that is our sweet spot, that plus plan. We also can optimize our medical collections with that plus plan and inquiries. So that's if we've got someone who's got a lot of medical out there or a lot of inquiries they need to remove, we'll coach them into that medium, that plus plan. So, and then of course the premium plan is for someone that's on a real short timeline, that needs to, maybe they're closing in 2 months and they, something has popped up or they didn't realize, or they're merging credit files together with a spouse and something happened there and they need to get something done quickly, and that's if they just want to throw the kitchen sink at it, then we'll put them in that premium plan. And that is the right plan for some clients, just to get them done very quickly. So, but I'm happy to talk with a client, to sit down with you. Like I said, I'm local. I'm in the Georgetown area, but don't mind driving down here or wherever to meet with you and a client to go over some issues. Certainly, we can talk on the phone and go over some things. But we're here to help you. We're here to help you close more and get the word out there. So appreciate your time today. Appreciate all of you being here, and take some time to walk around, eat some more sandwiches, talk with me, talk with Cody.
What's the cost of the plus plan?
The plus plan is $120.
And the
To get started.
price plan, how much is it?
400.
The premium 400?
If you go out to our website, we've got all that pricing and everything on there as well, where you can view the pricing and see all of that information out there.
We didn't talk about judgments. Do you have anything to tell us about judgments?
About what is a judgment?
Well, when you have one, how you can get rid of it?
That's a little bit different process. Getting judgments.
Judgment, the difference between judgment and collection, a judge has actually signed off on it and said, you owe.
Taxes,
You can't
child
do
support.
anything.
Yeah,
Okay.
taxes, child support, whatever it is. If
Or
it's a
someone
judgment-
takes you to court and you owe
Yeah,
money.
it went to
you know.
court and the judge signed off on it, you have to pay it. End of story.
So no
So,
settlements or anything like that?
Sometimes you can, I've heard of people settling it, but most of the time I tell people, like, you're done, like negotiations are over, we're past the collection argument stage.
Yeah.
It's signed, and
Anybody want?
you want the house, here's the number you gotta pay, we gotta clear this judgment. If you wanna buy a house, you can't close on the house with a judgment on there, so.
Could be paid closing, right?
Can't be paid at closing, and if it's a VA loan, we can have the seller pay for it.
Elevate the price.
How does the criminal record affect the credit?
We'll solve that problem in a minute.
How does your criminal record affect your credit score?
Actually, I don't know, 'cause- and I say this just because I've had people that have been incarcerated, recently came out. Usually it's just they kind of like disappear for a while.
Okay.
I've had some people where they've kept up with their, like some people just like, I don't care.
It can affect
That's-
underwriting for insurance though.
Mhm.
Yeah.
So that can be,
Even if they totally
yeah.
let it go, like
Right.
let their credit go. I've had some people where they actually kept up with it and like kept as an authorized user on a different card, so
Yeah.
somebody else using
Right.
the card for them, and their credit was totally fine. It just depends on how they handle their credit.
Okay.
And if they're gone for 6 months, 6 years.
Right. They may not be able to get a life insurance policy, but
I-
but they could, yeah,
Credit
that they could
score
probably, yeah.
800.
Yeah.
But he has a criminal record.
Yeah.
Yeah.
Well, and it also depends on, then you go back to underwriting, like, you gotta get a 2-year work history. You're like, oh, he's only been on the job for 2 months, where was he before that? Like, oh, that kind of thing doesn't work. So,
I know.
everybody's different though, so. Collections?
I do have a question,
Yeah.
not on collections, but, when you're dealing with people that are self-employed,
Uh-huh.
don't wanna buy a house,
Good question.
how far back do you look at their credit, as far as like? their
Credit or
I'm
earnings,
sorry,
income,
their
okay.
earnings.
So it depends on how long they've been in business. If they've been in business for 5 years or longer, technically we might be able to get away with 1 year of tax returns. So right around this week, since taxes are due in like 2 weeks, I'm telling everybody, give me your tax returns first before you officially file them with the IRS. So I can tell you how much you're gonna be approved for now, or if you kind of delete this, change this, if you want to be approved for that $300,000 house, do it this way, and then file with the IRS.
Really?
So, and I usually have that conversation in March. So it's kind of September, October, and then February, March, April timeframe. I'm having the same discussions on Depends on when people file. But yeah, if not, it might be 2 years that we average together. It depends on the loan program that they're doing.
Because I'm running into a lot of business owners out there. There's a lot of small contractors.
And depending on what they have going on, I usually tell everybody, send me all your stuff first and give me a shot at letting me help you buy a house. Does that make sense?
Yes,
So,
love that.
and 1 year they might have to write a check to Uncle Sam. Says cost of buying a house, you want to buy a house, get a decent interest rate. Because we can do the self-employed bank statement loans. I want to say the last one I did, the rate was 6.5. So I mean, it's not a bad, for them they're like, okay, that's fine, 6.5, that's fine. Yeah. Got the house, self-employed, all we did was average our bank statements for 24 months and they're approved, yeah. So they have plenty of money in the bank, so that helps too.
I'm sorry, this is for Susan. Are you just in the Austin area? Because I've got a client in Dallas.
We're a Texas-based company, and we can work with anybody in Texas. So yes,
I work with
you
a
give me a
group
call.
all over the state.
Yeah.
I have an office in San Antonio, Arlington, Houston. We work with them.
We don't have an agent in the area, but you know, we're just a phone call away.
Okay.
Yes,
Gotcha.
absolutely.
How long do you have to wait for bankruptcy for a mortgage?
Usually it's going to be 2 years, but it depends on the type of loan that they're doing. If it's going to be conventional or not, they might have to wait 7. So, but if you're just doing like an FHA or something like that,
It's 2 years.
yeah. So, and then sometimes is it Chapter 7 or 13?
I think it was a 13.
So sometimes I've gotten loans approved while they're in bankruptcy and still paying it. You have to get a judge to sign off on it to approve the purchase. So.
But if it's already
Yeah.
discharged, then it's already completed.
It's already completed. Usually it's going to be 2 years.
2 years.
Yeah.
One thing we didn't talk about was a short sale.
Short sale, if it's going to, we have to document it as a short sale as opposed to a foreclosure. So, because a lot of people will be like, oh no, I did a short sale, and then you go pull the records and like all the paperwork, and you're like, yep, this is a foreclosure. So there's going to be a difference. But yeah, on conventional, sometimes you can get away with 4 years on a short sale as opposed to 7 for a foreclosure, and then 2 years on a short sale for the FHA and VA type stuff. So, and you can have a VA foreclosure and give the loan back to the VA and go out and buy another VA house a couple years later. Yeah. People think that they have VA foreclosure and lost their entitlement. I'm like, no, just buy a house bigger than $144,000. You can use your second tier of entitlement. So I would say we specialize in VA probably more than anything else, because I have 5 people on my staff that I hired away from Navy Fed. So I took all the good people from Navy Fed.
Awesome.
So now the slow people are at the credit union.
You have Spanish speakers?
I got 1 Spanish speaker. So she can take care of it.
We don't. So if you know somebody who's looking for a side gig, we
That's
would.
me.
Yeah.
Okay. We don't have a Spanish speaking representative. It would be a great asset. So yeah.
Yeah, we take your Spanish.
Cody, how do your fireman loans work? Or can you tell me?
So it's really just a down payment assistance program for like the firemen, and it's kind of the same with the teachers.
Is there anything different? What's different?
It's going to be the same as the teacher.